Some big numbers coming out of the housing market today, and they're not looking pretty if you're looking to buy or rent.
But this sleight of hand is actually inflating home prices across the market.
Home prices in the large urban metropolitan areas were so expensive that people started moving out.
Literally no young person will be able to afford to purchase a home, period.
It's a lot harder for young people today to save up for markers of the American dream than it was for previous generations.
In 1985, the median home in the United States cost about 3.5 times the median household income. By 2025, that same ratio hit 5 times income. And in many cities, it's far higher. A generation ago, average incomes could buy average homes. Today, in cities like Sydney, Vancouver, and San Francisco, that feels almost impossible. This isn't just happening in one place. It's a global pattern. Wages grew, but housing prices exploded. So, what actually changed? The standard explanation is supply and demand. There just aren't enough houses being built. More people want homes than homes available. Prices rise. That's part of the story. Supply matters, but it's not the full answer. Because even in places where housing supply increased, prices still surged. And the timing of these price increases aligns with something bigger than local zoning or construction rates. The real story is this: housing became financialized. Homes stopped being valued primarily as places to live and started being valued as financial assets. And that shift changed everything. To understand why housing became expensive, you need to understand what happened to money and credit over the past few decades. Interest rates fell. For nearly 40 years, central banks pushed borrowing costs lower and lower. In the 1980s, mortgage rates were above 12%. By 2020, they had dropped below 3% in many countries. When borrowing becomes cheaper, people can take out larger loans. A household that could borrow $200,000 at 10% interest might be able to borrow $400,000 at 3% while keeping the same monthly payment. More credit entered housing markets. Banks expanded lending. Governments encouraged homeownership through tax breaks and subsidized mortgages. The amount of money chasing homes increased dramatically. And when more money competes for the same supply of houses, prices rise. This is the fundamental mechanism. Cheap money inflated housing prices. The cost to borrow fell, so the amount people could borrow rose, and housing prices followed. It wasn't just demand for shelter driving prices, it was the availability of credit. But something else happened alongside cheap credit. Houses became investments. For most of the 20th century, homes were primarily shelter. You bought a house to live in it, raise a family, and eventually pass it on. Appreciation was modest and secondary. That changed. As housing prices began rising consistently, homes became wealth-building tools. Equity grew. Homeowners refinanced and borrowed against that equity. Real estate became a reliable store of value, sometimes outperforming stocks. Investors noticed. Property markets attracted institutional money, foreign capital, and speculative buyers. In major cities, homes were purchased not to live in, but to hold as assets, rented out, left vacant, or flipped for profit. Housing stopped being valued only as a place to live. It started being valued as a financial asset. And once that shift happened, housing prices began moving in sync with financial markets, responding to interest rates, credit availability, and investor sentiment rather than just local wages and population growth. This created a reinforcing cycle. As prices rose, more buyers rushed in, fearing they'd be priced out forever. That fear drove demand even higher. Homeowners saw their equity grow and felt wealthier, which encouraged more spending and borrowing. Rising prices made housing look like a safe, profitable investment. More investors entered the market, more credit flowed in, prices climbed further, the cycle fed itself. Price increases justified more buying. More buying pushed prices higher. And because housing is also shelter, something people need, demand remained inelastic. People had to live somewhere. This loop is why housing markets in many countries didn't just grow, they exploded. Unlike most goods where rising prices reduce demand, housing saw rising prices increase urgency. The psychology shifted from buy when you're ready to buy before it's too late. And central banks, by keeping interest rates low to stimulate economies, fueled that cycle for decades. This isn't unique to one country or one city. It became a global phenomenon. The era of low interest rates was global. After the 2008 financial crisis, central banks worldwide slashed rates and injected liquidity into markets. That money flowed into real estate across continents. International investment followed. Wealthy individuals and institutions bought property in London, New York, Toronto, and Melbourne. Not because they planned to live there, but because real estate offered stable returns and a hedge against currency risk. The result? Housing became expensive everywhere financial systems were deeply integrated. Credit was abundant, and cities were economically vibrant. It wasn't a local failure, it was a systemic outcome. So, who are the ultimate winners? Existing homeowners prospered, their properties appreciated, often faster than wages or inflation. For many, their home became their largest asset, a source of retirement security and generational wealth. Younger generations, by contrast, found it harder to enter the market. Saving for a down payment became a multi-year or even decade-long endeavor. Renting absorbed a larger share of income, leaving less to save. The gap widened. Those who owned property before prices surged benefited enormously. Those trying to buy afterward faced steeper barriers. Asset inequality grew, not because of income differences alone, but because of timing and access to credit. Step back, and housing prices fit into a larger pattern. As we explored in Why Every Country Keeps Borrowing More Money and Why Governments Need Inflation, modern economies are built on credit expansion and debt. Low interest rates support that system by making borrowing affordable. Housing is one of the largest recipients of that credit. Mortgages are the biggest loans most people ever take on. And when central banks lower rates to stimulate growth, housing markets respond. As we discussed in Why Your Money is Worth Less, inflation erodes the value of currency over time. Real assets, like property, hold value better than cash. That's why housing became not just shelter, but a hedge against inflation. Houses became expensive because homes slowly turned into financial assets inside a system designed around credit and growth. Cheap money made borrowing easier. Easier borrowing pushed prices higher. Higher prices attracted investors. And investors reinforced the cycle. Supply constraints also matter, but the ultimate driver was financialization, the transformation of housing from shelter into an investment class. Understanding this changes how you view housing. They didn't become expensive by accident. They became expensive because the system treated them as assets. Thank you for watching, and we hope you enjoyed the video. If you're liking our content, please hit the like button or leave us a comment. We'll see you in the next one.